Well, Seth Bernstein is the chief executive of AllianceBernstein. He joins me from New York. Before we get to what we should do, Seth, the Fed has not popped the balloon, but it has certainly taken air out of it this afternoon by suggesting that in their latest minutes that the monetary accommodation is going to be removed faster than previously thought. In other words, they're going to switch to attention to fighting inflation. This is not good news for investors in the short run.
No, it's not good news in the short run, but it can't be a surprise to the market that the Fed was growing increasingly concerned about the rate of inflation, particularly wage inflation. So yeah, it's quite a reaction. But you don't see it quite as pronounced in the fixed income markets as you have in the equity markets. So I'm not overly concerned about this short-term blip, but yes, they're certainly taking away the punch bowl.
Right, and the market was already highly volatile as a result of Omicron. Do you think we are now facing some form of correction? Arguably amongst some stocks it's already there. Some higher flyers are down 20, 30, even 40%. But, you know, in terms of a market broad range, what do you think the Fed will stomach before pausing? 15%? 10%?
I don't think they would ever admit they had a particular threshold for pain, and they're really going to look at how the money markets are working to see if there's particular stress there. Look, you know very well that this rally, and it's an incredibly powerful one, has been very narrow. And you know, the S&P is up, I think as of year end, was up over 100% over the past 3 years, but it was incredibly concentrated, and so we are seeing a rotation. Whether this time it will hold, hopefully it will, and you'll see a broader breadth of stocks begin to recognize on the real value. We continue to see real value here. We just don't want to be terribly concentrated in equities at this point, just given the overall levels.
Now, when you say this, because we've got viewers, myself included, who say when he says we don't want to be concentrated in equities, what does that mean to the viewer who looks at you and says, well, Seth's got billions that across all the various funds, this, that, and the other. But what do I do with my pension fund when I see this coming? Do I make any changes, or do I just sit quietly and watch?
Look, when I say overly concentrated, I'm talking about breadth within your equity exposure. The average individual has no alternative. I don't have any real alternative other than equities long term. And so we think they have to remain invested. We don't have a crystal ball. They don't either. Yep. We would, on balance, be a little less aggressive in equities than we were, 6-9 months ago. But the fact of the matter is we remain fully invested, and we still think there's value to be had there. And so my advice to people is to stand pat.
And we've had a few guests over the last few weeks who have said the normal thing that people do in these, buy the dips, because obviously if you've done that over the last 5 years, I mean, with the exception of the 1920 blip of COVID, but you'd have done very well. There is a view now that caution. Buying the dips is not necessarily. You've got to be far more selective on which dip you buy and how deep the dip is before you buy.
I agree with that. And I think people do have rules of thumb, whether it's 20%, 25%. But look, you've had such a disparate market in terms of its performance. There are lots of stocks that are nowhere near their 52-week highs. And so you might be a little more aggressive with those than ones that were, if this rotation continues to persist. But yes, I think that rule of thumb remains a reasonable one, but I certainly think being more selective. And I think, frankly, being active at this point in the cycle probably makes more sense for most people.
Good to see you, Seth. Thank you. We've a long 12 months ahead, and I do hope we can call upon you throughout the year to guide us where we're going.
I'm happy to do it. Thank you for having me.